You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm rejoined today by our special guest, Luke Hallard, for part 2 of our interview. So if you've not listened, we did part 1 a few weeks ago, which I thought was excellent. So you might want to go back and listen to that first, or you might want to listen to this first to see if you do want to go back and listen to the other one. But either way, there is a part 1. So Luke, I'll just jump straight back into it. Firstly, thanks for coming back on the show again.
Delighted to be back on. Had a good chat last time. I think it ended with me 2 or 3 beers deep. So I've got the sparkling water and a cup of tea here this time. And I think this time we're going to get into some of the stuff that's actually in my portfolio. So there'll probably be a whole misery tale to tell about several of these positions that are really seriously in the hole right.
Few tears in this one compared to the last one then. So you said in the last interview that you've bought one thing a month since about 2010. Do you think it's important to invest with this kind of regularity? And if so, why?
I do. So, but actually it's almost, the benefit is almost to prevent me over trading. So I try and limit myself to 1 trading day a month. And typically it's sometimes in the first week of the month. So sort of 2 aspects to that, right? It stops me from kind of doing things too quickly. And if we think back to that conversation we had in the part 1 discussion, I try to be really methodical about my trades, buys or sells or adding to positions. So if I have a bright idea on a Tuesday, I know I have to wait until the start of the following month to execute that. Kind of gives me that artificial barrier to doing something that I might live to regret. But then I suppose you were asking the question more from the perspective of, is it beneficial to keep adding money? And I think, yes, absolutely. So, your listeners will all be familiar with dollar cost averaging. And that's a benefit whichever way the market's going up or down. It's just going to neutralize that volatility a little bit. And I will say, I don't buy every month. So some months I'll do absolutely nothing. And when I do buy, I'm not always buying a brand new stock. Like sometimes the best thing to buy is something you already own. So often, in fact, my last couple of purchases, at least 2 of those have been into stocks I already have in my portfolio. And if your listeners are thinking about doing this themselves, adding money regularly, like thumbs up, that's a great idea. But I would say be wary of trading fees. So if your individual buys are, if they're not at the right size, you don't want that fee. Say you spend £10 or £20 fee to make a purchase in your portfolio. If you're doing a trade that's say less than about £1,000, well, that's getting on for like 1 or 2%. So you're kind of giving yourself some additional headwinds to overcome with your returns. So I would always try and monitor fees and not be over trading to the extent that I'm making life a bit too difficult for myself.
I find with myself that, so I'm pretty similar in that it's just when I get paid, X amount goes into the portfolio. I find it probably helps a lot when the stock market's doing what it's doing at the minute, especially with the growth stocks where they've pulled back a lot. Because, like, for example, I did have some cash, a decent amount of cash on the sidelines a few months ago. So I piled that in thinking I was getting some great deals, which I think in the long term I will have done. But in terms of timing, I'm absolutely horrendous. Because if I was good at timing, I would have just sat on a big pile of cash. And I don't even know now whether now's a good time to buy or not, if you knew when the bottom was. And I think just buying regularly does help with that. Because although you won't put everything in at the bottom, at least psychologically, you might catch it just by accident.
I think that's bang on. Like, none of us can predict this stuff. And I've gone through the same emotional wrangling with myself. I thought I was buying at a great value point. Suddenly the stocks I'm buying are available 10, 20% cheaper, like days, in one case, hours later. It's a good and a bad thing. I think in the long run, we're not going to care if some of our investments are like 20, 30 times what we bought them at. We're not going to care whether it cost us an extra 10 or 20% when we bought them. But yeah, it can be painful at the time. But that's, and I think as you're hinting at, that's the benefit of investing regularly. Like, you're evening out those bumps in short-term volatility, and like, wow, how could it be much more volatile than things are right now?
Well, I've just finished listening to the 2022 Berkshire meeting, and one of the questions Buffett gets is about timing. And the person asking the question, he talks about all the times where it looked like he timed it very well. So I think he got out in like, I don't know, like 1970 or something, and then it crashed, and he got back in 73, 74, and he did a similar thing in, I think, 2000. And they basically said, how are you so good at timing? And he said, well, I'm not. If you look at what I did in 2008, he put a lot of money in 2008. He wrote an article for, I can't remember who it was, like Wall Street Journal or some publication like that, saying buy American and why now was a good time to buy stocks. And he said, if he had any sense of timing, he'd have waited for 6 months, because he missed the bottom by quite a bit. So if he can't do it, you just got to accept you're probably not going to be able to.
Quite right. You can't beat yourself up too hard about this stuff. I think if you focus on the key game, which is finding good quality companies, kind of don't sweat the valuation too hard, as long as you know you're buying a company that has long-term solid prospects.
You talked about in the first interview working from anywhere and how that's a sector that you quite like. You talked, I think it was more in relation to Airbnb in that first interview. What do you think of outsourcing companies, for example, Upwork and Fiverr, then, in relation to that and how they fit in?
Yeah, cool. Let's talk about all of those. Actually, before we get into any of the companies in my portfolio, I want to do a little bit of a scene set, if you let me, perhaps for anyone who hasn't listened to part one, because we're going to talk about some companies here that I firmly believe in many cases. And nonetheless, they are down significantly over the last 6 months. So kind of why is that, before we get into the nitty gritty of the individual companies? And growth stocks, I'm a growth investor. Almost my entire portfolio is in small cap, mid cap equities, apart from a couple of the monsters we'll talk about today. And that class of company has had a major valuation reset over the last 6 months. I think last time I checked my portfolio, I'm down like Douglas Adams 42%, I think, from my peak. So it's pretty painful. But I think what's happening here, we have to think about what drives valuations. And valuations are really driven by two things. They're driven by the fundamentals of the company itself, like how much money is it making? How efficient is it? What's its margins? How's it kind of driving profits? And then valuations are driven by those fundamentals, but also by the valuation multiple that the market assigns. So if we're in a kind of pre 6 months ago mode, risk on mode, wasn't unusual to see companies trading at 40, 50 times sales, kind of slightly crazy number. And now we're in a risk off mode. Everybody's worried about supply chain challenges, inflation, interest rates, also, war, all these sort of terrible things happening in the world. And that's causing growth investors to kind of run more towards value stocks. Perhaps, it's like some of the companies that you more typically talk about on your podcast. And so those multiples have come down, and where 50 times sales might have been acceptable, albeit we all would have thought that was kind of crazy. Now, even companies trading at 10 times sales are considered expensive. Now, the reason I kind of call that out is all of these companies, they've taken a battering, but they've taken a battering because valuation multiples are down because everyone's in bear mode. But at the same time, the fundamentals are up. We're going to talk about some companies today like CrowdStrike that are just posting quarter after quarter growth of kind of crazy numbers. So these companies are getting stronger. And at some point, and who knows, is this going to be next week, or is it going to be next year, or is it going to be 10 years time? At some point, growth is going to be back in fashion, right? And 50 times sales is going to be, back and as strong as ever. Perhaps we won't get that high, I don't know, but certainly we'll be back in risk on mode. And at that point, these companies are still going to keep executing like hell and building their fundamentals. So when these companies come back, they're going to come back really hard. And so that's why I'm confident when I say I'm focused on what the companies are doing, not what the market's valuing them at. So there's a bit of a scene set. Hopefully that made sense, because I'm now going to talk about some companies, and we'll start maybe with Airbnb, that I think are executing great, but their valuations are in the hole. And I'm kind of ignoring that a little bit. So you asked about, I think the original question then was about some of the kind of work from anywhere companies. So I think I said in part one as well, I like to invest in mega trends. I like to think about what are the things the world is going to need more of, and then think about the kind of secondary effects of that and find companies that I think are providing services that the world will need more of in the future. And I do think Airbnb, will start there, is one of those companies, and fvrr and Upwork. So, why do I feel this is the case? Well, the nature of work is changing. I'm quite lucky. I've now got an entirely remote job working for Seven Investing, but even my old employer, HSBC, used to work for a big global bank. That's largely a fully remote job now. I've got ex-colleagues who spend a lot of time working remotely and then come to the office. I think HSBC actually very forward-looking in this respect. Come to the office for meetings, collaboration, like stuff where you want to be in a room together with your colleagues. You can get your job done just as well remotely. And I think many companies are kind of opening their eyes to this. So this creates an opportunity for a company like Airbnb because they're enabling folk to uproot their families, go live somewhere much more interesting than perhaps in the suburbs of a big city, on the outskirts of London, like I live currently, and sort of take advantage of that flexibility while still being very productive. And so this is very much played into Airbnb's business model, and they're driving much more of a push around long-term stays, trying to open up travel from, instead of going to like a boring, maybe resort hotel, let's go stay in a really unique, interesting vacation property where I've got a proper kitchen and a barbecue and maybe a swimming pool to myself and a real neighborhood and an actual environment. I think that's the kind of trajectory that folk who are working are going to want to take advantage of. So I'm really, I have a very high conviction around this company. Now, it's taken a battering along with the rest of the market. I think the valuation of Airbnb is about $67, $68 billion today, currently trading around 10 times sales. So that might even still, prove to be a little bit expensive at 10 times sales. Perhaps there's a little bit further to go, but long term, they're executing really well. And they've been free cash flow positive since 2021. I just think the model's really smart, and I think it's set up to benefit from the way the world is changing.
So what do you think about outsourcing companies and like Upwork and Fiverr? I don't actually remember if they're in the portfolio or not, but they're just, if you're talking about working from anywhere, to me, they were just two that sprang to mind.
Yeah, totally. So, that whole same mega trend, flexible working, and let's take Fiverr, because I know that company a bit better. It is in my portfolio. I think I did own Upwork years ago, but divested out of that. And if I'm honest, I can't remember why. I'd have to go reread my diary.
The growth rates were slower.
Good.
The previous CEO, I don't think he was really getting it done. They've got a new woman in, or they did a couple of years ago, and it seems to have picked up quite a bit since then. So it could have been something to do with one of those.
Yeah, could be. But Fiverr's in my portfolio today. So, if you don't know what Fiverr is, it's a gig economy company. So if you want to get a professional to provide some sort of service, could be creative, artistic, bit of technology, maybe, build me a website, maybe write some marketing copy for me, maybe help me write my CV, a whole ton of things, maybe produce a piece of art for me. There are hundreds of different categories of service, and you can engage with, really actually very professional, very experienced suppliers, kind of gig workers, to provide these services. And it's called Fiverr because stuff used to cost $5, and now they've sort of gone up market much more, and you can still get some services at that rate, but things typically are a bit more expensive. It's a fantastic company. It's loved by both its buyers and its sellers. It's kind of a two-sided marketplace. So you go on there, you post if you're a supplier, you post kind of a gig. I will write your CV for you, and then buyers will come and buy from you, and then they'll review you. So you get this kind of eBay-like reputation model. And both buyers and sellers love the model. They both give like a market-leading net promoter score, which is a good measure of how much your customers actually enjoy using your services. And I think something interesting is happening with Fiverr right now, because they're trying to push themselves up the quality curve. So I suppose maybe if I contrast how I used to think about Fiverr and Upwork, but this is probably an out of date view. I used to think of Upwork as being much more sort of serious, kind of like a real, not a real job, but still a gig job. But actually, you're doing like a contracted piece of work, which might be multiple days or weeks or months. And Fiverr might be kind of a one-off thing. Well, I think Fiverr have changed that now, and they're really stepping into the territory that Upwork used to occupy, where actually Fiverr, the platform, are offering a whole bunch of services to let a Fiverr worker, like one of the service providers, kind of manage their business on the platform, have a long-lasting relationship with the client, and really just operate in a much more slick way. And as they do move up the quality curve, you get an interesting kind of network effect going on, I think, because then you're bringing in higher quality sellers who are charging a higher rate because they're getting the kind of capabilities they need to operate effectively on the Fiverr platform. And then those high quality sellers are going to bring in more serious buyers. So you get this kind of nice flywheel, actually, that's going to increase the average cost of a Fiverr gig, which is going to be really good for the platform. I suppose if I think about, it's quite a small position in my portfolio, and it's much smaller recently because it's taken a real hammering in the growth sell-off recently. But one thing that's kind of held me back from topping up that position and making it a bigger exposure in my own portfolio is I'm a little concerned about the take rate. Take rate is kind of the tax, I suppose, that Fiverr charge. So how much money do they earn on every transaction? And it's, if you add up the fees to the buyers and the sellers, I think it's about 25%. And that seems like quite a high number. And actually, every time they issue a quarterly report, that take rate seems to be increasing. And it's something that their leadership team seem to celebrate. It's not 25% isn't necessarily unsustainable, but they probably need to offer a wider range of more sophisticated services to justify that charge. Because if we think about, say, the buyer-seller relationship, and particularly as Fiverr are trying to build longer-term relationships between buyers and sellers, it's not that hard to say, hey, look, email me directly. And if we're going to be working together for a year, email me directly, I can offer you a cheaper price. I'm sure that kind of stuff goes on all the time. And, Fiverr don't want to get themselves cut out of the transaction. So I think it's just something for an investor in Fiverr to be aware of.
I don't know if they might already do this, but I've not used it for a while. So I have used Upwork and Fiverr. When I used Upwork, I know that I think it starts at like 20%. So I was the contract, I think that's right, contract. So I was the one doing the work. This is years ago. And then once you got over a certain threshold, it would then drop to like 10%. And I think the lowest one might have even been something like 5%. So for something like Upwork, if you are doing that longer term work, that works quite well. But yeah, like you said, I've always viewed Fiverr as, even now, I still view it as sort of like, I guess more like one-off designy stuff. So for example, if I needed to hire someone for a long-term contract, say I wanted to start getting the podcast transcribed, I would probably look on Upwork for that. Whereas when we launched a podcast a couple of years ago and we needed the logo and the intro, just straight away I went to Fiverr. But the problem is, if you're doing more of the designy one-off stuff, it doesn't lend itself, because I've not been back on since. So I would, even if you spend enough with someone, the take rate drops. I'd just never get there with the sort of things I'm using it for. So you mentioned you've not topped up on it because you're worried about the take rate in the longer term. Do you have any thoughts on the valuation, especially now compared to, because I think Fiverr's down about 90% or something ridiculous. I think it did get over 300 and it's about 36 now. Upwork's down a bit less, but it didn't go up as much. Just out of interest, what did you think of the valuation at 300?
So there, if we talk about market cap, I guess it makes a bit more sense. So I'm just looking at the graph now. So the market cap looks like it's $1.3 billion. And at its peak, market cap looks like it was, click into it and see, substantially higher. That's 11, nearly $12 billion. $12 billion is punchy, but I think it's hard to lolook at that stat in isolation. I guess you have to look at it through the lens of valuation relative to the revenues. So
I want to say fvrr got to about 40 times sales from memory. We covered it. I don't know if we covered it at the top, but we covered it at one point, and it was about 40 times sales.
Yeah, exactly right. And now it's 4.3 times sales, so 10 times less. Yeah. So, what do you take away from that? If you bought it at 40 times sales, you're probably kicking yourself a little bit. If you're buying it today, are you going to come to regret that? I don't know. Like 4 times sales seems pretty reasonable, to be honest. They've got an enormous, retinue of suppliers on there. They're one of the only global platforms doing this kind of thing. Both their suppliers and their providers love them. 4 times sales doesn't seem unreasonable. That might fall into the bucket of oversold.
Yeah, because I think as well with the price to sales, I think it's easy to forget that a lot of these companies, they're unprofitable by choice, really, because it's all going into R&D, sales, marketing. If they were to just completely stop the marketing, assuming that maybe enough to maintain the current size, what would the earnings be? And I think if you look at it like that, I don't actually know. I've not gone through and done that for fvrr, but I mean, you could be at the point where it's at a PE of like, I don't know, even conservatively under 20 or something like that. And yeah, just that's one to me where I'm surprised it's down so much, just because I think fvrr and upward, the more fvrr, it's probably at a price I never thought we'd see again, unless something went drastically wrong in the future. Like we covered it it was a company I always liked. I had Upwork for years. I bought that just after the IPO. So that was quite a bumpy one, because I think I bought around the current price actually, but like $17, $18. I think I rode it all the way down to about $4, and then it went up to about 60, and then now it's back at 17, 18. I always liked fvrr, but I struggled with the valuation, because by the time I thought, I was a bit dismissive of it when it first went public, annoyingly. And then when I started having a proper look at it, it was already at the silly multiple. So then when I think it peaked at about just over like $320 a share or something. And we covered it one time on the show a few months ago, and it come down to 120. And I thought, oh, well, that looks pretty good. So that was when I started my position. And then now it's at 36. So it goes back to what I said about market timing. I topped up at 60 as well, because I thought, oh, how much lower can it go? And then within like, I think 2 weeks, it'd been cut in half again. So you talked about Shopify in the first interview and the ride you've been on with it. I think you said it was an 80 bagger and it had pulled back to about a 20 bagger at the time of recording the last interview. You said off air that you weren't really sure what your thoughts were on this company. So do you want to talk a bit about that?
Yeah, I think I described it as I was having a bit of existential angst over this one in particular. I think that's accurate. So it's the stock I've traded the most, but there is a rationale for that. So I first bought a position in March 2016, and I kind of went through my sort of quality gates. I tend to buy sort of a 2% position. If I really like a company, I'll add another 2%. If I really love a company, I'll add a further 2%. I went through those 3 stages pretty quickly, it looks like. So I bought in March, July, and December of 2016. And I rode that up to some pretty crazy sort of real money numbers in my portfolio. So even though I have huge conviction in the business model and what they do, and we'll talk about that in a sec, I still have, if I get to say 20% of my portfolio value in one stock, I start to get sleepless nights a little bit. So it's one that I've had to trim along the way. And so whenever Shopify got to that 20% of the portfolio number, I would sell a chunk out. So I made some sales in 2019, 2 in 2020, and then most recently in November 2021. So like, don't shed any tears for me, because I've taken out my initial investment.
No, don't worry.
many, many times over. But what was left in there was still pretty substantial. And, at that point of the last sale in November 21, I think I brought it down to maybe a sort of 16 or 17% of my portfolio position. Well, it's taken a hammering, probably more than anything else in my portfolio. I think from its highs, it's down 80%. That's a pretty precipitous drop off. And there are some good reasons for that if you have a bit of a short-term perspective. this is now actually back to being kind of a 5 or 6% position in my portfolio, which is something I didn't expect. I thought it'd always be one of the big ones. So let's talk briefly about kind of who they are, what they do. And I suppose I was trying to articulate like the bull case and the bear case in my own mind. And then maybe you can help me determine how I sort of navigate my way through this existential angst I've got about the company. So the bull case, well, what does Shopify do? Right. So they're a kind of a platform for doing e-commerce. If you're actually Heinz are one of their customers. If you're Heinz, then Shopify will provide you with the capability to have a really nice mobile-friendly website. You can do that lots of different ways, but Shopify do a great job of that. They can do your sales on the back end, but they can also help you manage your inventory. They can help you with your logistics. So, you put your baked beans in Shopify warehouse and they'll deal with the delivery down to the last mile delivery. And actually, sorry, they don't quite do last mile, which is actually a part of my bear case. Let me reset that. So they kind of help the whole end-to-end journey around running a brand. And they've proven themselves from the tiniest website that might be selling like mugs and hats to enormous global brands like Heinz and many other brands that use them. So they kind of sit at both ends of that market. And their customers love them. And I think they're a really important company because if you're a small retailer and you're trying to get exposure, right, there's really only two ways to kind of go hypergrowth with your product and scale out efficiently and get to kind of national or international delivery. And if either you do a deal with the devil and you list your products on Amazon Marketplace, or you use Shopify, and there are other sort of similar tools like Shopify, I think they're the best, and get the same capabilities and the same scale. It kind of, we're looking as a small business person, kind of efficient way to scale up our business. So, why do I say do a deal with the devil with Amazon? And, I'm an Amazon shareholder because they've got a bit of a bad track record of if your products are successful, well, Amazon know that because they're managing all your transactions for you. And whenever they see something, or not whenever, but sometimes when they see a product that's doing really well or a category that's doing brilliantly, they jump in and they take over the market by launching an Amazon Basics version or their own branded version of the product. They basically cut you out of your own market and they've used your own data to get there. So that's pretty risky strategy to take to list on Amazon. But it's, the upside is you've potentially can, scale to international growth very, very quickly because they've got the capabilities to help you do that. Well, Shopify are very different. This is why I think it's such a fantastic company. I think retailers need Shopify because if we think about the difference between Amazon and Shopify, Amazon's customer is like you and me, the guy who receives the package, the end customer. Shopify's customer is the retailer, the guy in the middle. And that comes across in a number of different ways. So if I receive a package from a Shopify-enabled merchant, it comes in the merchant's own packaging. If I'm buying, kind of stupid example, we'll stick with Heinz. I'm buying Heinz baked beans. Clearly, I really buy them from the supermarket. Trite example. If I buy Heinz baked beans, though, then if they're shipped by Shopify, they'll come in a Heinz branded box. I don't even know Shopify were anywhere in there. They're kind of hidden away behind the scenes. And it all looks like Heinz, the website, the payment, the receipt of the inventory of the order. If I buy with Amazon, it's coming in an Amazon box. Clearly Amazon are putting their own brand first. And so retailers, they want to keep their own data. They want to keep that direct customer relationship and they want to make their own brand prominent, kind of control that as if they had hosted it themselves. Well, working with Shopify, partnering with Shopify is much closer to that. And you haven't got that risk that Shopify is suddenly going to launch a competing product. It's just not the business they're in. So this is why I think the world, or at least retail, needs Shopify, because you still want to scale, but you want to protect your business. What's the bull case around a Shopify investment, though? And probably some of the stuff they've done recently around kind of social commerce. So they've launched a number of capabilities in the last year or two that are enabling their Shopify merchants to reach consumers on the channels that consumers already use. So what do I mean by that? Now, if you're a Heinz or whoever, a small retailer, where you can integrate the whole Shopify purchase experience into your Facebook page or your Instagram page, you can put it on your TikTok account very soon. I think it's launching, may have launched already, but launching in the next few months, if not, embedding the Shopify kind of purchase experience into Google. So, within search, within maps, images, YouTube, Shopify make it really easy to surface your products at the touch point where you engage your consumer already. And then they've got a really interesting partnership they struck a few months ago that it's going to take them a while to get fully up and running, but a partnership with JD.com. So JD.com are, I think, China's second largest retailer, 500 million active buyers on the JD.com platform. And what the Shopify partnership is going to do, it's targeted at getting the time it takes to launch a product into the Chinese market. Evidently, it takes like a year to get set up, figure out your international logistics, work out kind of payments and FX, and be able to kind of list the product on a Chinese language website, to put the whole thing together. That takes about a year on average. Shopify are targeting that, getting that down to 4 weeks, like a month. So that's really quite interesting. And if you're already a Shopify merchant, well, it'd be very easy suddenly to launch your product into this, the China market where 500 million new buyers. So I think that's really quite attractive. There's a ton of other stuff, but in my mind, those are some of the key bull arguments for investment in Shopify. Now, the bear case is all around what Shopify call the SFN, Shopify Fulfillment Network. So that's basically that logistics bit, including the last mile delivery. And how do you get the merchants' packages into your warehouse and then from your warehouse out to the consumer? And there's obviously some intelligence there as well, because maybe all your Heinz baked beans are coming from one particular source, and they're going to be wanted maybe internationally, perhaps around the world. And you want to be able to get to, let's say, 2-day delivery at a minimum, because Amazon have really pushed the bar there in terms of changing consumer expectations of how long it takes to order something. So if you want to get like baked beans within 2 days of me and within 2 days of someone in some other far-flung part of the world, well, Shopify they have to sort of pre-deliver them to logistics centers that are kind of close to major population centers all over the world. And they need some real intelligence to do that, to work out where are people likely to order that product. So where should I build like a stock of it? That's big, that's complex, it's hard, it's expensive. And so the bear case is Shopify are on that journey. They've built some of the logistics network they need, mostly by partnering with third parties. They do have their own warehouses, they got their own sort of transportation, but they need to make that much more robust. And so they're in the process of bringing some of that stuff in-house, scaling up. Maybe one day they buy airlines and all the various things that Amazon have had to do to get to the same level. And that's just going to be very expensive. So they've committed $2 billion over the next 2 years to get to 2-day delivery to 90% of the US population. Well, and then quite recently, they've taken a knock because they committed $2 billion and they actually just went and spent $2 billion by acquiring a company called Deliver with 2 R's, who I think are kind of I'm not too sure, they're like business intelligence kind of software company around kind of figuring out how you run this logistics network. So I imagine that $2 billion on Deliver was incremental to the $2 billion they'd already committed. So if you're an investor with a short-term perspective, you're looking at this company and saying, guys, what the hell? Like, you're now spending potentially $3 to $4 billion to build up this fulfillment network that you really should have had already. That's going to cost you a lot of money. You were talking earlier, Sam, about sort of profit margins and, can companies get kind of profits to the bottom line? Well, Shopify are going to be spending a lot of the retained earnings, a lot of the money, a lot of their operating profit, they're going to be spending now, reinvesting in the company to build up the fulfillment network. So I think now we've kind of told that long story. The kind of existential angst is probably Shopify hasn't finished selling off. It's probably more pain to take, because I think the market's going to look pretty harshly on this company over the next couple of quarters, maybe even longer, while they continue to make these investments in the fulfillment network. But if you can take a long view and see beyond that, and this is probably, minimum 2 years, perhaps more like 5 years, well, I think this could be, I'm not going to say an Amazon beta, but I definitely think this could be $1 trillion company one day. And when I said that, 80% ago, it was a significant doubling. To still say that now, when they've taken an 80% haircut, that's a significant multiple based on its current valuation.
Do you think the distribution and last mile delivery, do you think that's something that's worth doing, or do you think it's something they have to do? Just because, like, businesses that spring to, and I don't know the economics of it, but businesses that spring to mind are sort of your Deliveroos and your Ubers, where they might be fantastic for the customer, but they don't really it's not a very profitable business model. Kind of like Just Eat as well, which we've looked at a few times. We sort of semi-like Just Eat, and then they started getting into delivery, and it just completely put us off, because we've seen what Uber and Deliveroo were doing, and we just thought, well, if you're a small restaurant, it's just a no-brainer. Just get Just Eat do it, because if they're willing to lose money doing it, you're not going to find a better deal than that. So do you see it being more like that, or do you think it would be something they should be doing rather than something they just have to do because everyone expects it?
Yeah, it's a good question. I mean, I suppose what retailers and customers expect is, like, the package arrives. So, how Shopify do that, kind of don't care, but Shopify have to recognize that Amazon every quarter are increasing all of our expectations around how quickly stuff can get delivered. I've been a Prime member for a good number of years now, and most stuff I'm buying is next day delivery. So there's a competitive disadvantage there if you can't get close to that. So I think, to your question, they have to do it. Now, whether they have to do it themselves in-house, which is the current strategy, or they do it by outsourcing and partnering with other outsourced logistics providers, there's strategic question for the company there. But they're going in that former direction. They want to take control of it. I think longer term, Toby Lutke and Harley Finkelstein are super smart guys. I think that's probably going to be proven to be the right trajectory. There's an interesting sort of factoid here as well, I think, that if we think about take rates, again, we talked about take rate with Fiverr, how much money the platform makes on every transaction. Well, Shopify's take rate today is, I think it's less than 3%, might be like 2.7%. And in comparison, Amazon's take rate on their third-party marketplace is nearer to 30%, so kind of 10 times the profit. So you could look at that in a couple of ways, right? But I suppose without getting too deep, the one that excites me is this opportunity to increase the take rate. So as Shopify do start to build out those capabilities, and they can offer a service that's kind of almost comparable with Amazon's, but as a retailer, you're owning your own data, owning your customers. You don't have that kind of deal with the devil risk of engaging with an Amazon. Well, you're going to be happy to pay significantly more than the 3% that Shopify get today, probably nearer to the 30% that Amazon charge. So as Shopify scale up, I think that's a massive opportunity for them to not just arbitrarily increase the take rate, but increase it as they're creating additional capabilities and making it a more valuable service for their retailers.
Do you have any thoughts on how saturated I don't know if saturated is the right word, but I think I'm probably misremembering the stat, because I only saw it in passing, and I don't actually own Shopify or Amazon, so I won't take it in as much. But I'm sure it's something, when you look at the proportion of online transactions, I think it's in the US. I think number one is something like, I want to say like Amazon with 20%, and then Shopify second in 10%, or it's Amazon's 10% and Shopify second in 6%. But it's that sort of thing. How large do you think that can get significantly larger, or do you think would not matter necessarily, just because online transactions are probably going to keep going up a lot anyway. So even if it maintained the same market share, that could be enough to do very well. So yeah, what are your thoughts on that?
I think I agree with you. And I think I maybe saw the same stat that you did. May have been posted by Benedict Evans, one of the guys I recommended as a Twitter follow last time we chatted. And I think Benedict a few months ago shared a graph that showed the relative size of Shopify versus Amazon's third-party marketplace. And you're right, Shopify is now kind of half the size of Amazon's third-party marketplace. Like Amazon are massive. That's actually quite a significant market share for Shopify. And they're growing. They're catching Amazon there. Whether they ever overtake them, kind of, who knows? They probably don't need to, though, to be wildly successful. If we think about e-commerce penetration overall, still actually a tiny fraction of stuff we buy is bought online, bought through apps and bought through websites. In terms of, money spent, the large majority is still offline purchases. Seems a bit strange to me because I do almost all my shopping online. But I guess if you look around the whole world and you look at all demographics, still there's a long way for e-commerce to grow from where it is today. So that's a rising tide that's going to lift all boats. I think Amazon are the biggest, and they're only going to get bigger. But Shopify now, I think, have established themselves very firmly in that number 2 spot. And so they're going to continue to benefit too. And if you just compare the valuations of Amazon and Shopify, there's significant valuation growth for a Shopify shareholder compared to an Amazon shareholder today. I think Shopify is something like a 40 billion market cap. Gosh, I can't remember what Amazon is, but it's up in the 1.5 trillion, something like that, isn't it?
I don't actually follow Amazon. I just know it's pretty big.
Yeah. It's $1 trillion, 1.1.
So what's the price to sales of Shopify now? Because I know it was as high as 80x, I think, at about the peak.
Yeah, it's 8.7 right now, and 7 on a forward basis.
So the share price is down 80%, but because the business has doubled on the price of sales, it's down 90%.
Yep.
Is that cheaper than pre-pandemic? Do you know, or I don't know what? Oh, okay.
Yeah. Yep. If we just look at its, if we look at the market cap, it's back to. I'm just doing it by eye here. Looks like it's back to actually literally just pre-pandemic, kind of December 2019. But if we look at it on a price to sales basis, it's now, what did I say? 8-ish, 8.7. Yeah. Gosh, you've actually never seen. Oh, no, there we go. I have to go all the way back to. I have to go back to where I first bought it, March 2016. There we go. I'm right back to my initial cost basis.
How does that factor into your existential crisis then?
Makes me want to add some more.
I think we got to the bottom of that then.
Yeah.
It probably follows on quite nicely because you've talked about the partnership with JD. You've got a couple of Chinese listed stocks, BYD and JD, in your portfolio. Well, what do you like about these? And also, what do you think of the risk of investing in China?
Yeah, it's a tough one. So I think, why did I buy a bunch of Chinese stocks? And I bought a few others, Xinyi, Solar, Baidu, possibly some other stuff. So personally, I kind of realized maybe early last year that I was just perhaps a bit too overexposed to the US market. And I wanted to build a bit of international exposure. And I've lived in Hong Kong, and I've got some contacts out there, and I feel like I understand that market a little bit. But also, if we think about the trajectory of these two global superpowers, and hopefully we don't see them actually end up in conflict with each other, but certainly China is on the ascendant, and quite an important factor in favor of the US right now is the US dollar is the kind of the reserve currency of the world. It's not, I don't necessarily think that's going to change in the next decade, or maybe even longer, but it's not out of the question that one day the renminbi, like the Chinese currency, could be the reserve currency of the world, or maybe it's a cryptocurrency, who knows. So very, very large, very wealthy nation that's on the same sort of journey, and as the US, and able to accelerate much faster because of the nature of the sort of political system there. They can just get stuff done in a way that it's very hard to get stuff done in the US or the UK. We won't go into too deeply why, but for not necessarily for great reasons, but just kind of it's how it is. So about a year ago, I was thinking, okay, I need some more international exposure. China seems like a decent hedge against perhaps a US decline. So I built a kind of sub portfolio in my SIP, because I do all my investing in my ISA in the UK. So for international listeners, tax efficient investment account. There are only certain markets that are approved for holding equities in an ISA, and the US is included, and many Asian markets are not. So I built my China portfolio on my SIP, and my SIP has taken an absolute pounding. So for lots of reasons, all of my China stocks are really pretty horribly in the hole. My timing was pretty terrible. My SIP provider and my investment advisor that helped me make that kind of pension move probably both think I'm a complete idiot. But I suppose I've achieved my objective, which was to have a more international portfolio. And although I'm still invested in growth stocks in China, in theory, I've now kind of balanced myself to some small extent. My China portfolio is materially smaller than my US portfolio, but I've balanced myself to some small extent in terms of the sort of geographical risk, at least. So you asked about BYD and JD.com. So I guess why did I pick those stocks? I guess we talked about JD already, China's second largest online retailer, kind of, a bit Amazon-like. I just think that's, for all the reasons we just talked about with Shopify, I think that's a growing sector. BYD are quite interesting. I think it's an acronym for Build Your Dreams. And they're a bit of a conglomerate, but they're essentially a manufacturer of electric vehicles, so not just cars, but also trucks and buses and monorails, I think. And they've got a subsidiary that produces batteries and other electronic components. So without getting too deeply into kind of the mega trends behind that stuff, kind of electric vehicles is, for me at least, the kind of trajectory of transportation. And BYD are one of the leading companies in China, and China are making a real kind of EV transition. They're pushing that very hard as a nation. So again, both these companies, JD and BYD, just seemed like, a bit to an outsider, kind of in the right sectors, the right mega trends, based on my somewhat limited perspective, in a market that I think could go up as the US goes down. So just trying to hedge in that way.
What do you think about the delisting risk, if anything?
Yeah, it's pretty ugly, isn't it? And I've forgotten my sort of recent history, but a number of companies have been delisted and some others are under threat. And certainly, JD and BYD are threatened in that way. So the risk here is that some of these companies list in the US under an ADR, American Depository Receipt, and for various sort of political and transparency reasons, China might either force the companies to delist, or the US government might force these companies to delist. And if we do end up in a situation of kind of conflict between the US and China, perhaps related to Taiwan, well, that's probably maybe existentially bad for all of us. Maybe the last thing I'll be worried about is my portfolio. But, depending on how that situation plays out, some of the posturing might involve one or other of the governments forcing these companies to delist. So if they do delist from the US, then although in my SIP, I've bought the Hong Kong listings of these companies, they're still going to sell off pretty hard, because suddenly you've got effectively all of the North American shareholders forced to sell their stock. And so that's going to depress the price. So there is that kind of long tail risk that if that happens, all of these ADR listed companies could take a significant hit. I think that's priced in a little bit because the China market has taken such a hit. But if it actually happened, well, I'm sure there'd be more kind of doom and gloom ahead for that part of my portfolio.
Do you think in the longer term it could be beneficial if they were delisted? Because if they were just listed in Hong Kong, I think even for the last few years, you talk about the sell-off they've had, but I mean, like Alibaba, I think it's at like $80 now. We covered it when it was about, I want to say about $200, and it was at a P of about 20 or something at that point. And we thought it was incredibly cheap. If you looked at the growth rate and compared it to his peers in the US. So I do wonder if it was listed solely in Hong Kong, would it get a higher multiple in the longer term after the initial shock? Which I don't know. But
no, I think you're totally right. Like the market seems to be a bit unimaginative, and right now, when the world is in kind of a risk-off mode, then the market tends to overreact in the short term to things that look ugly. But you're right, in the long term, the fundamentals of these companies haven't changed. If they're delisted and suddenly, their equity is suddenly on sale, it doesn't actually change the way the company is executing at all, really, other than stock-based compensation and things like that. These companies are still doing the same revenues, selling the same products, and that's really the important thing. So yeah, you would like to think that at some point, as a long-term buy and hold investor, those short-term impacts are just kind of washed through, and the companies will be fairly valued based on what they're actually doing.
It reminds me a bit of a lot of the big tech, because we've covered a few of them on the show, and I think the biggest risk with some of them is that they'll get broken up. But then when you actually look at what's inside some of them, so if you look into Google and I guess Amazon as well and Facebook, and you look, I think for most of them, the sum of the parts would actually be worth more. I struggle to see us, and I mean, for example, with Google, if YouTube was separately listed, what would that be worth in today's market? Like with Amazon and Amazon Web Services, Facebook and Instagram, you've just got, if they actually were split up, I think in the longer term, that would probably increase the valuations in a similar way to, well, a bit like with Standard Oil, where once that was actually broken up, people realized how profitable it was. And the sum of all the parts traded for a lot more than Standard Oil ever did. So with that, how do you feel about companies like Google and Amazon, which you do have in your portfolio, and the valuations, and whether or not the law of large numbers will at some point start to actually affect these companies?
Yeah, so look, I consider these to be like the blue chips in my portfolio. A non-growth investor might consider these to be risky investments. I don't think that's the case. They're at such scale and such dominance in their markets. I agree with you that breaking them up could be potentially better for shareholders. There's certainly some bits of the Alphabet empire I would rather own than other bits. I don't doubt that they get some great network effects by having, they've got something like 9 products now with over 1 billion users each. So there's an incredible network effect there. As if you're an Android user, well, you're probably also a Chrome user, which means you're probably also a Gmail user. You're probably using Google Drive as well. These things all kind of come together. But if they can keep creating like some of the world's best products in each of these categories, like Google Maps, right? There's nothing even close to that in terms of capability. I don't know if you're sort of geeky like me and you watched their Google I/O event maybe last month or a few weeks ago. Like where they're taking maps is just incredible. Where you can suddenly.
Where are they taking it? Because I didn't watch it.
Yeah, I think they're launching for San Francisco, London, New York, and a couple of other big cities. Basically, like, have you ever played with Google Earth, either in VR or just on the web? Kind of look at cities in 3D. Yeah. Well, they're turning that into like Sim City with hyper realistic weather effects and little people and cars driving around. Obviously, well, actually, it's not even completely simulated. So this sounds incredible. But Google obviously have all this real-time traffic data from Waze and from other Android phones running Google Maps and with location data. So that's why Google can tell you the shortest route to get to your destination and where the traffic jams are. So when you look at like the Sim City version of London, you'll see like traffic jams. It won't be the actual cars, but you'll get a much like just this fantastically immersive sense of what it's like to be in one of those cities. So, it's not a million years away from having, a truly real-time view of the entire world. If anybody's going to do that, it's going to be Google first.
So what do you think about the valuations then for Google and Amazon? Do you think, if they can continue putting up the kind of numbers they're putting up, they're pretty cheap. But the problem is, when a company's that size, that's definitely not a guarantee.
Well, I mean, here's two stats that I found incredible, and I haven't looked in detail at either of these companies in the most recent quarter, but I did maybe 5 or 6 months ago. So, let's not forget, these are both trillion-dollar companies. What did we say? Amazon's just over $1 trillion, and Google's 1.4 trillion, give or take, right now. So, given that they are 2 of the 3 most valuable companies in the world, I think, or maybe 2 out of the top 4, Google in Q4 last year grew its cloud revenues 45% year over year, and Amazon have increased revenues 40% year over year. Like, those are insane numbers that you'd normally expect from a company that's still in like hypergrowth mode, like a young company that's maybe a $2 or $3 billion valuation, not a company that's like getting up between like a $1 and $2 trillion valuation. Seems insane that they can continue to compound their revenues at that rate. So is there an end to how big they can get? Well, they're massive now, but if we think about, I'm going to get a bit science fiction-y here, so forgive me, but if we think about the trajectory of society, right? How many years before we are a multiplanetary species, right? Maybe it's a couple of decades at max. Would you buy that, Sam?
I think it depends on your definition of multiplanetary. I think we might have a few people on Mars, but I wouldn't expect much beyond that.
Sure. Okay, I buy that. But you can see where I'm going with this argument, that these Google and Amazon, they're not young companies. They've been around for multi-decades. And I think if you're a Google or Amazon shareholder for another couple of decades, well, suddenly, having Amazon Prime on Mars isn't out of the question. And the whole, Shopify fulfillment network, when you need to
I'll hate that when they have to do last mile delivery there.
That's right. Yeah, exactly. So I'm being a bit daft here, but I suppose what I'm saying is, if these companies can maintain their culture of innovation, and if they can still be doing like 40% plus growth at the incredible scale they're at today, well, maybe they can't do 40% forever, but I don't think there are necessarily terrestrial limits to their ability to continue to compound revenues for really a very, very, very long time.
What do you think about, or not what do you think, but would you be able to talk us through your history with Tesla? Because I think it's from maybe listening to your podcast that you used to do with Albert, but I was under the impression that Tesla had been quite a big winner for you. And then looking at it, it only makes up about 3% of your portfolio now. So at some point, I'm assuming it's been trimmed significantly.
It has, and it's kind of trimmed itself because it's sold off with all the growth stocks. So I think about my history with it. Let me pop up actually on my portfolio manager and I'll have a quick look at this while we chat. So yeah, I had a relatively big investment in Tesla, which kind of, grew from my first purchase, forgive me, in 2013. And it looks like I went through those same 3 stages of buy in 2013, 14, and 2016. And my cost basis on those looks like it's about $160. So, that's appreciated quite nicely. And that's pre-splits, I guess, as well. So yeah, I'm doing pretty well on that. Now, I love the company. I love the product. I've got a Tesla parked outside. I would love to be a Starlink user. I haven't quite got the need for that right yet. I'd love to be a SpaceX shareholder, but sorry, we're going a bit off track here. Yeah, I love the products and I love the company. And I think I'll always be a Tesla shareholder. But with a company like Tesla, you've got this existential risk of Musk. Like, he's the company's greatest asset and its greatest liability in many ways. Like, he's an incredible businessman, incredible engineer, but he is erratic as hell. I mean, look, if you just look at what he's done to the Twitter board, that's pretty wild. I sold my Twitter stock the day after he announced his intentions to take it over, just because I knew it was going to get pretty wild and pretty ugly.
Smart call so far.
Yeah. Well, I mean, clearly, I think there was sort of limited upside. There's probably a 4 or 5% upside when he made the announcement from the current price to the acquisition price, and substantial downside if things went bad, which they do seem to be going at the moment. So that's a pretty easy call. But yeah, in terms of my Tesla stock though, so I did those kind of buys in up to about 2016. And then probably I didn't quite have the 20% tolerance that I did for some other companies. Like I do reserve that 20% exposure for the stuff I really, really, really believe in. And with that Musk risk, I think I've probably, I can't work it out on the fly, but I've probably kept Tesla to under about 15%. And I think I remember a conversation with Albert in 2020 where I said, look, I'm just uncomfortable with how at the time, how expensive the company was. Like the valuation just felt a bit out of whack. Even though I had good conviction in it, it just felt like a company that had sort of outsized risk to be a significant position in my portfolio. And so I sold a couple of times through 2020 and 2021. So I think I sold it down to about a 6% position. And I remember saying to a few friends and to Albert, I'm probably going to keep it at 6%, but it's down, I think over the last 6 months, it's down about 50% from its peak. That's kind of how I got to the 3% it's at today. And probably not one I'm planning to add to, but I still think it's a fantastic company. Like it's a free cash flow machine now. And I didn't look too hard at the most recent earnings, but I think I did put out a tweet which compared Tesla's operating margins to like Ford and GM and Toyota and some of the others. Tesla are now way ahead. Like they had to invest a hell of a lot of money to get to that level of efficiency. But now, I haven't got the numbers here from recollection. It's like an operating margin of like 17%, I think. And their competitors are down at 12%. Like Tesla have charged past them in the most recent couple of quarters. And I mean, how do you get your operating margin, if you're a Ford, up to be competitive at this stage? I don't know if it's possible.
Well, if you're Ford, would you be looking at it saying we need to get it up to 17%, or would you be looking and saying that's going to come down at some point?
Maybe. I mean, do your shareholders buy that? Is it going to come down? Like, what's really going to drive the cost of or drive down Tesla's operating margins?
Well, I was just going to say, do you not sort of, when you talked about with Netflix in the last interview, where you talked about how you felt like the competition was a lot stronger, you weren't using it as much. I don't know. I do feel like if for example, like now compared to 2016, some of the competitors to Tesla now are fantastic, and a lot of the competitors are going pretty much all in on it. But I mean, we see it at work with like the P11D cars, and you do get the Teslas, because obviously the P11Ds, you're incentivized to buy electric cars inside the company. So you see the Teslas, but we are seeing like the Porsche Taycans and the Taycans and the Audi e-trons and stuff. And whereas 5 years ago, if these same clients had been getting an electric car, they'd have only got Tesla. Whereas now that's not the case. And that would be my concern with it.
I agree. And it's good, right? Because actually in many ways, this is what Musk has been trying to achieve, I think. It may not be the thing that shareholders want, but the mission of Tesla, if I get it right, was to accelerate the world's transition to sustainable energy, and so he's licensed a lot of their patents and IP out to competitors to say, like, guys, we're leading the way, but come on this journey with us, right? Because he's got this, or at least he says he's got this bigger picture objective. But if we come down to the Tesla company, yeah, I think there are good quality competing products. And there's no argument that Tesla is a relatively expensive vehicle. If you put like the Porsche and maybe some of the electric Mercedes and BMWs that are coming aside. But well, here's something a little bit anecdotal, and then we'll talk about some of the optionality. Like I'm getting ready to renew the car, and we're going to get another Tesla. So I happen to look at the resale value of my car that's on the driveway. It's 3 years old, 3.5 years old, pretty low mileage. And if I sell it on Auto Trader or part exit with Tesla today, overall, it will have cost me £4,000. It's basically almost the same price that I bought the thing for. And I've driven it for 3.5 years.
Is that the Tesla though, or is that just where the secondhand car market is today? Because you drive a new car out the lot and it gains 20% in value.
Yeah, that's right. That's right. You're exactly right. As I say, super anecdotal, fuel prices and supply chains mean that, yeah, secondhand car market is pretty wild. And if it's the electric secondhand car market is on fire. So I don't expect that to last. But if we come to the stock and the kind of optionality around it, I don't know that the other manufacturers can effectively compete. So sure, they could probably build a vehicle that had similar specs. I don't know, will they be supply constrained on batteries? Because Tesla really have got that locked up with their Gigafactory model. I don't know that the other competitors can compete on software. Like I've got FSD, like the full autopilot in my current car. It's kind of a gimmick. And actually, I wouldn't buy it on my next car, at least until it does what Musk says it should be able to do, which might still be several years away. But they're closer to that full self-driving than any of the other manufacturers. The only other company that seems to be close is Google's Waymo, who've now scaled out to Phoenix, I think, like a second city. I don't think anyone else has seriously got anything that's much more capable than, like holding a lane and maybe integrating with the sat nav. The Tesla autopilot today in the UK it's a bit gimmicky. It's good, but you can kind of see where it's going. So yeah, from a software perspective, just they seem to be leagues ahead. Now, we haven't even talked about I don't want to get too Musk fanboyish, and I'm not sure I buy all of this entirely, but we haven't even talked about like robots, right? Which is now part of the Tesla business model. And if you believe the hype, which I try and be skeptical about such things, but there's an air of truth around it, sticking like a robotic workers in factories, that is a significantly bigger market than sticking a couple of million automobiles on the road. And I kind of buy the logic that if Tesla can solve full self-driving, having a robot walking around a factory or walking around your home tidying stuff up for you is not that dissimilar. Like you just have a kind of, a piece of machinery that has to navigate itself in the human world. So I can get that if you solve one of those problems, you've probably solved the other one at the same time. So yeah, some interesting optionality around a Tesla investment, which is, again, I'm kind of taking us a bit of a sci-fi direction, but if you're a Tesla shareholder, I think you can make a very strong case for the valuation today just based on the cars. And then if you do buy really any of these kind of random potential futures around kind of software, robots, all the other stuff that they've got in the pipeline, well, that's like a low probability chance of having a massive upside. I kind of like that random optionality in my investments.
See, I do think I am much more of a Tesla skeptic. I'm partly bitter because I had it in 2016 and sold it, so I'm aware that influences it slightly. And so I bought Solar City shares just before the merger because they were trading at a discount to what would have been the price if it had gone ahead. So as soon as the merger went through, I just took my 15% gain and ran, which obviously was in hindsight, I missed out on a 20x, but that's life. But my issue with Tesla is it is really, I do have concerns about the margins, but for me, it is the valuation. Because I think if you look at what a normal, I appreciate if you think they can sustain the 17% operating margins, then it would deserve a higher valuation than your Fords would. But I'm a bit more simplistic, and I do think they'll come down. But I also think, well, if you look at Ford, what are they trading at, like a P of 10 or something? What does Tesla's sales need to get to for it to be at a P of 10? And it's an incredible amount of growth. So I actually think that my view is that even if you think it's the best business in the world, I think so many, I've not looked at it probably since it was cut in half, but I think just so many of the returns have been pulled forward, and the amount it needs to grow just to justify the current share price, I don't know why someone would start a position in it now. That's my concern with it.
Yeah, I don't disagree, which is why why it's a relatively small allocation in my portfolio today. But they're a big company and they're still doing 70, 80, 90% year over year revenue growth. So it don't take too many years at 80% growth to bring that PE ratio down substantially. Like they have got a profitable model that's delivering significant free cash flow. So they've proven the business model works. It's just a case of continuing to execute and continuing to grow at the same rate.
Do you think those growth rates would be, or not the growth rates, but do you think those high levels, if they do grow, would be sustainable? Because if you look at the internal combustion engine, when that was catching on in like the 10s and the 20s, you had these very, very high figures. even compared to today, I think they were quite high figures, the amount of automobiles being sold in America. And then you got to a point, I think it sort of coincided with the Wall Street crash and the depression, which didn't help, but the sales just fell off a cliff. And I think part of the reason was all these people that didn't have cars now had cars. So you then rather than just bringing in new people that have never had a car before, it's just the people getting in, updating the car, which is probably a smaller market. Do you think there's any risk of that with electrics, where you're going to have this massive surge of people coming in for the first time, but then actually longer term, it won't sustain those higher levels?
Yeah, maybe. But then you've sort of induced me to talk about another bit of the optionality, because you're right. Individually, we own, at some point, Tesla are going to reach some sort of peak saturation, and then it's just about people renewing their cars. But maybe the world of transportation is going to change if, and again, it's like the sci-fi thing, right? If Tesla get full self-driving and then like robo-taxi, that's the bit we didn't talk about. So if suddenly they can get cars, the same number of vehicles being used much more though, because, the robo-taxi dream is you use your car when you need it, when you don't need it, you kind of release it to the Tesla network and off it goes. It operates like an autonomous Uber effectively. And then when you want it back, you let it know and it drops off its last passenger and comes back, and then it's your car again. And you as the owner make a chunk of revenue. This is all kind of smoke and mirrors at the moment. Like the technology is there. No one knows what the business model is going to be. But if you buy that they can develop this capability, but it's not inconceivable that they could get this business model working. Well, so sure, Tesla might have reached saturation with like the capital benefit of selling vehicles, but suddenly they may have turned on this new revenue stream, which could be enormous, right? If they're suddenly, if we do get to a world of autonomous taxis and, as one of the premium manufacturers, if Tesla is some substantial percentage of, all mileage, well, and suddenly if I can buy my car, and although I might have a large capital outlay to buy the car, I know I'm going to recoup some decent percentage of that year after year because the car suddenly is a revenue generator for me as an individual. Well, I'm more likely to buy a Tesla because I know it's out there earning me money, and Tesla are getting like a percentage, undisclosed percentage of every journey. Forget robots and forget the other stuff. That in itself could be a massive revenue stream. So there's just a lot of different kind of potential legs to how Tesla can grow beyond just selling automobiles, I think.
Do you think any of those options are particularly like in the next few years, or do you just think there's enough options that you just need one of them to hit that it's fine? Or is there one where you think, well, actually, I think they're quite close?
No, they're probably all a chunk of time away. Like, Musk's track record at predicting when FSD will be kind of prime time and released hasn't been great. But, I think, I'm going to forget the details here. I think ARK Invest, I listened to one of their podcasts, and maybe Kathy Wood was talking about their own Tesla sort of valuation models. And I think they have FSD as being somewhere between 2023 and 2026, with 2026 being like a more likely weighted outcome. I kind of buy that, I think. And, sitting in my own car today, like it's a million miles away from full self-driving. It's a joke at kind of how bad it is in some situations. Seeing some videos of FSD in the US where they're kind of different regulatory environment and the car's allowed to do a bit more, looks pretty impressive. But you have to filter all this through the kind of Elon Musk kind of hype bubble and try and see beyond the the kind of enthusiastic Tesla fanboys, of which I kind of am one, although I'm trying to be quite skeptical here to see the reality of it. So I know it's impossible to even put with any confidence put a number on it, but I guess I would be surprised if they didn't have some form of like proper self-driving in urban environments subject to regulations keeping pace by 2025, 26.
It's a really difficult question to answer because of hindsight bias, but do you think you would have said the same thing 5 years ago?
Yeah, yeah, probably. Yeah, you're right. What's that term about where you tend to overestimate what can be achieved in the short term and underestimate what can be achieved in the long term? It's probably a definite one of those.
So moving on from Tesla, because we could literally be here all day. What do you like about CrowdStrike, and how do you feel about the valuation? Now, CrowdStrike, just for a bit about, I'm sort of familiar with what it does. It's not a company I've ever followed, so I don't actually know what the valuation is. I just know it was one of those really expensive companies that was at about 50 times sales at some point, but I've no idea what it is now.
They've taken a pullback, and right now they're $33 billion and 22 times sales. So I think if I was really being objective, then
that's held up quite well then, hasn't it? That's still a high multiple.
It is, yes, exactly right. I totally agree. So it's, if I wasn't so convinced about how critical their capabilities are to the world, then that's probably one I'll be getting a bit uncomfortable with at a 22 times price to sales. That's the kind of valuation that is, any company almost indiscriminately, the babies are being thrown out with the bathwater here. So why does CrowdStrike deserve a key place in my portfolio? I definitely consider it, a top 5 or top 6 position in my portfolio in terms of my conviction. Why does it deserve that, even though it's still comparatively quite an expensive stock? And it's just kind of the nature of the world we live in today. And I think it's never been sort of pointed to so strongly as kind of what's happening between Russia and Ukraine, China and Taiwan. Apparently, the Taiwanese government face 5 million cyber attacks every day, the majority of which originate in China. If we think about our own sort of experience on the internet with like malware and Trojans and phishing and all sorts of kind of, bad actors trying to con us out of our money or extort money from us in different ways. So cyber security in my mind has never been so relevant. And I just cannot fathom a future where it becomes, it kind of wanes and becomes less relevant. It's about a 3% allocation in my portfolio. And if it wasn't for the fact that kind of growth is just selling off indiscriminately, I'd probably be adding to that. But I think that's one I'm going to be a bit more patient with, just because the market might take a kind of gloomy look on it. But at a $33 billion market cap, one of the, I think arguably the sort of leader in cybersecurity, endpoint security, with just an enormous array of capabilities. That's kind of why it's one of the companies I have the biggest conviction to.
I do caveat this by saying I don't really know anything about it, but what's so good about CrowdStrike in particular? Because it must have a lot of competitors. What is it is it just that it's a leader, or is there something else it does?
Yeah, they do endpoint security. So that's kind of their focus. And they do some clever stuff with kind of real time. So let's say it wasn't an endpoint, it's like your computer, your mobile phone, your tablet, an Internet of Things device. It's like the stuff at the end that we actually use that kind of do processing. And so when these things are kind of protected by CrowdStrike, if you think about it simplistically, so if you say you've got like a McAfee or something on your computer, and then it does a virus scan every so often, and then maybe every couple of days it downloads the latest kind of virus definitions and scans everything again. Well, kind of CrowdStrike are doing all that stuff in real time, but it's not about having like a bunch of computer scientists in a room who are, as humans, analyzing what's going on and kind of defining the next version of the kind of virus checker and then shipping it out. The CrowdStrike Falcon platform is doing this in real time. So it's actually looking at, forget the number, something like 4 trillion events every day on all of these different endpoints, and using some very clever technology that I can't begin to fathom, is figuring out in real time when kind of a novel attack that maybe has never been seen before is taking place, and is able to not only kind of prevent that at the point where it's taking place, but simultaneously roll out the same protection in real time to all CrowdStrike customers. So, very sort of proactive monitoring of endpoints and security.
Have you ever heard of Darktrace?
Yes, I have. Yeah, UK company. Yep.
Yeah. I was just wondering if you'd heard of it. We had someone on the show a few months ago who talked about that one, but again, it's not one I've looked at. I was just wondering if you'd come across it.
I think so. They probably wouldn't do too wrong with Darktrace, with Sentinel-1. It's another name I've heard in this space. Like, I think this sector is only going to grow. I do think CrowdStrike are probably the leader on most metrics in terms of kind of capability and by revenues and by number of customers and by growth. Like they're a big company, but they're still growing at a heady rate. So yeah, I'm sure Darktrace are going to do great, but in my mind, I don't know too much about the Darktrace product, to be honest. But in my mind, kind of happy to back the winner, back the leader in a growing market, and be relatively confident that investment's pretty safe.
You touched on it a bit in the previous interview, but you've got a large exposure to healthcare. What is it about this sector that you find so attractive?
I'm getting old myself and starting to fall apart, I suppose. So, I do think about my investments as being kind of voting for the companies, putting my actual financial support behind the companies that I think are delivering important capabilities in the world. So I'm not a doctor, I don't aspire to be able to sort of save lives in medicine, but I can support companies that do that with my investing dollars and by kind of talking about them on podcasts and things to draw attention to some of the great work they're doing. So why is this sector a mega trend in my life, in my sort of map of how the world works, though? I suppose a few things. Like, we all expect to live longer, healthier lives, for one. And the nature of medicine, I think, has changed in the last decade or two. So medicine used to be about, like, I don't know if I said this on the part one or not, used to be about conditions that had like a start and an end. I've had my appendix out. There was I needed an appendectomy to resolve a serious issue when I was a kid. Do the surgery, it's game over. Well, hopefully it wasn't game over for me. It's at the end of that illness. But these days, medicine is more dominated by chronic conditions that don't really have an end. And medicine's becoming more about either trying to prevent them in the first place or help people manage them. So we're talking about things here like diabetes and heart disease. And so, not that I want to come at this from a kind of commercial way and say, oh, look, fantastic, we make all this money from all these poor people who have diabetes and heart disease, but it's the nature of the world. And so there are enormous revenues to be made by companies in this space. Now, I think so that's kind of the bigger picture thing. I think there are some really interesting innovations happening in this space, and I'm not an expert in any way, but as a layman, probably to pick out maybe 3 or 4 things that I think are quite interesting and are changing the nature of medicine. So one is AlphaFold, which is part of Google's DeepMind. So DeepMind produced AlphaFold, which is predicting protein structures and the way proteins fold. And that has moved our understanding of biology forwards in quite incredible ways. I think that was quoted last year as being the most important advance in AI ever. And I think if you asked an AI researcher today, they might point at a slightly different innovation from DeepMind, which might be the new most important advance in AI ever. But AlphaFold's certainly up there. So that's really going to help scientists and biologists develop revolutionary new drugs and treatments and drive a faster pace of innovation in the healthcare space. So there's one. Another one is kind of advances around mRNA as a result of the COVID pandemic. So I think we learned quite a lot about mRNA, it's the sort of efficacy as a way of treating certain kinds of conditions as a result of very quickly trying to get COVID response out there. And Pfizer and other drug manufacturers have used those technologies really effectively. Well, suddenly we've learned a lot we can apply to lots of other fields beyond just COVID. And evidently there's like some great advances happening around anti-malarials in that same space. So, like another whole field that's been opened up because we were forced just to figure this stuff out because of COVID. CRISPR-Cas9, like gene editing, it's kind of old news, but we've been talking about that for quite a while now, probably over a decade, but it's just starting to have real therapies. I think Editas and the company CRISPR are doing some really interesting things and starting to apply this in humans to resolve, long-standing, really quite terrible conditions for people. And we're barely sort of scratching the surface of what that technology can do. And then one of my colleagues, Max Chatsko, educated me about fairly recently was synthetic biology in a company called Twist Biosciences. So this is kind of, again, I'm not an expert, sort of DNA synthesis. So kind of, programming or designing an organism and then being able to kind of brew it, create it in a lab at relatively low cost. So you put all these things together, suddenly we understand the human genome in a way we never did before. And we've got the tools through things like synthetic biology and CRISPR to do something about it. I think we're in the early innings of a revolution in medicine.
So that's the end of the scripted questions. Just one other thing I just thought of that is not really relevant to anything we've discussed, but if we've got any listeners that say they started investing in about 2020 and they've never actually experienced stocks going down, what advice would you give them at the minute if, say, their portfolio is down 70% from the peak and they've never experienced it before?
Yeah, it's tough, right? So I sympathize, and I do have some close friends who are in that position where they joined our little investing WhatsApp group, enjoyed the heady 2000s where everyone kind of doubled their money, and 2001 where everything was like a little bit more stable, but they still made some decent returns. And then the last 6 months where like the ass has fallen out of their portfolio and they've reset back to way below where they started. So it's difficult. But probably a few things to take away from this, right? Investing shouldn't be as easy as it was in 2020. Like it's not normal to do like 90, 100% returns in a year. It's a long game. And, if you're investing in the market, if you're getting kind of a market equaling return, you're looking at sort of 8-9% a year. And if you're aiming to beat the market, you're probably pretty happy with a 12 or 13% return. So doing like a 90 or 100% return, you're either bearing much too much risk, or you're just, you're in that crazy environment where everything is on fire. So yeah, for one, I suppose the main takeaway is it wasn't supposed to be as good as it was. And now we're kind of reverting to the mean. So in terms of advice, I would say be a bit introspective and think about how you feel about this. And if this feels like horrible and unsustainable in a way that's ruining your life, then you've probably invested money that you need in the next 5 years, right? If you followed the principles of good long-term investing, shouldn't really have money invested you're going to need in the next 5 years. And I would be shocked if my portfolio was lower than it is today in 5 years' time. I would be mortally shocked if that was the case in 10 years' time. So as long as I've got money in the market, I don't need over that period, and I shouldn't be sweating it. If we go right back to the start of our conversation today, this is an opportunity, right? Where suddenly these fantastic companies that are compounding their revenues and executing brilliantly are available at discount prices. So if you have the opportunity to add new money, this is not financial advice, do your own due diligence. I think this is a very good time to be putting new money into the market. If you're sweating the money you have in the market and you're thinking, oh my God, I've ruined my life. Well, you probably broke some of the principles at the start by investing money you shouldn't have been investing because you suddenly find you need it. And then the other thing is, if you're finding that psychologically just too difficult, well, maybe investing in individual companies isn't for you. And maybe what you should be doing is investing in passive index trackers and kind of not worrying about it, having like a little piece of your salary going directly into like an S&P or a NASDAQ or a FTSE tracker, and then just don't look at it. Don't worry about it. Come back in 30 years' time when you're retiring, and I'm pretty confident you'll be happy with that decision you made.
Thank you very much for coming back on the show. Is there anything else you'd like to say, or if you want to just plug yourself and Seven Investing, because you've not done that on this one yet?
I will, thank you. So you can find me on Twitter. I'm at 7 Luke Hallard, number 7 LUKEHALLARD. I'm a lead advisor with 7 Investing. So I will say some of the companies we talked about today, not all of them, are active 7 Investing recommendations. So Sam, I think you might be a 7 Investing paying subscriber, so you probably know which ones.
I am indeed. Yeah.
Very good. So you know which ones are the recommendations and which ones aren't. If listeners want to find out, though, pop by the website 7investing.com/subscribe. Right now, I think on our subscribe page, we're offering a massive 85% discount. So sign up now for the bargain price of not very many dollars, and you'll get access to an enormous repository of over 100 different companies with a deep 30-minute deep dive video where I and my fellow lead advisors kind of pitch our stocks and get challenged by each other. You'll get a 2,000-word recommendation report for each of those. And probably most critically, most valuably to an investor, you'll get regular company updates. So if our investing thesis isn't playing out, we'll write an update, publish it for you, and you'll be first to hear about that. And if we really think an investment is broken and we think it's time to sell, we'll tell you about that too. So a lot of value there for not a lot of investment. I would say probably the few dollars I invested in my 7 investing subscription, getting on for about a year and a half ago, has paid me back in spades, albeit I've given all of those lovely gains back in the last 6 months. But let's take the long view.
Okay, well, thank you very much for coming back on the show again. And thank you everyone for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.